Bloomberg Audio Studios. Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Joe Weisenthal.
And I'm Tracy Alloway.
Tracy, every day feels like stocks and gold go up. Every day, stocks and gold and stocks and gold. And it's relentless.
I'll tell you what, it's good for anyone invested in an index fund and a bunch of gold coins that their dad gave them.
Yeah, good for you.
Yeah, thank you.
The Tracy Alloway portfolio doing very well.
Yes. No, you're absolutely right. And the big thing about this is it's not really supposed to happen, right? Like, you're not supposed to see stocks shoot up because of optimism about the future while gold simultaneously goes up, because gold traditionally is this sort of dour yellow rock, as you like to describe it, which usually signals something bad is about to happen.
I'm going to relent. I'm going to relent on something.
Are you a gold bug now?
No. Well, I'm going to relent on something.
Okay. Here we go.
I admit that gold is a metal. This is my big cave. I always
It's no longer a rock.
Yeah, this is my big cave. I used to say, oh, those yellow rocks. You know what? I'll acknowledge it's a metal.
If it's a metal now, will you admit that it has industrial application?
I mean, yeah, but they're very minor. And this is also, I will not acknowledge that there is it is mainly a store of value, or perceived to be. And when people are fearful, when people are mistrustful, when people don't trust fiat currencies or the governments, and there's all kinds of reasons to be skeptical about the governments that issue paper currencies, I understand why people want to hold this metal that people have used as money for thousands of years.
I'm going to take you back to the jewelry district in New York and get you more excited about gold again.
No, and I'll just say on gold, I loved it. And I wore that big chain when we went to the diamond district, and I wish I'd bought it. Like, because now that's like my big regret.
In hindsight,
it was like $35,000 gold necklace, and that today would probably be a $45,000 or $50,000 gold necklace.
Imagine how much that diamond encrusted Furby would be worth.
This is the thing they don't tell you about gold, by the way. If you spend $10,000, this is my crank take on gold. It's not crank. If you spend $10,000 on a gold necklace, they give you a $10,000 gold necklace.
Yes,
it's free. It's like you spend $10,000, they give you something worth $10,000 back. In a sense, it's a free transaction.
No, you get two things. You get something to wear and an investment.
Yeah, you actually, I wish I had had this realization when gold was like $200 an ounce. But anyway, it took me a while. Anyway,
we'll make a gold bug of you yet, I'm sure.
So these are really exciting, wild times in the market. And the last time we talked to this guest was another wild time and an exciting time in the market. That was, of course, April. We do, in fact, have the perfect guest to try to understand everything that's happening all around the world in global macro. We're going to be speaking with the vice chair of global macro at Deutsche Bank, Ozan Tarman. Ozan, thank you so much for coming back on Odd Lots. Last time we talked to you, we were in London. This time, you're in New York. So thank you for coming to visit us.
Very good to be in New York. I love to be on this show. I mean, honored to be invited again. Unga macro dinners, this is the highlight.
Oh, thank you.
Thank you.
And by the way, I was going to bring my United Amamim jersey. Okay. Dear Joe really looks like him. And some baklava for Tracy, but couldn't find in the airport. Next time, when you're in London.
That's a good reason to do another future episode. Actually, we talked a lot about gold in the beginning, but I don't want to first ask about gold. Is Nvidia swallowing the entire U.S. or maybe even global economy?
Almost hand in hand, right? These two questions. I mean, they both continue to go higher and higher. Actually, let me start with gold, because you did put such an intro in it. One of the very famous memes on the internet, a caricature done maybe 2-3 years ago. This gentleman or lady running a big macro hedge fund looks around. I run very complicated products, but at the end, I buy gold. And these days, that resonates even more. Mentioned even more and more in these roundtables, in TV studios like this. Normally, that jinx things, but it doesn't, because at the moment, it works in risk on and risk off. Last time you were around, again, you called me at a very relevant time, questioning U.S. exceptionalism. I'm sure we'll go into that. What's going on with U.S. institutions. Those question marks, all those question marks against the dollar, help gold. FX is about stories against dollar. I'm sure we'll go into this as well. Some of the stories are now having a less easy time. Then people like to go into gold. And we're maybe going into a rate cut period, cycle or not, whether you're Miran or Hamak, that differs. but gold works in that as well. So for the moment, I always feel, when it's the top trade on TVs, on my roundtables, I put the orange sign on, but at the moment it works for a reason. Now, Nvidia. Yeah, I mean, if we had this show a year ago as well, you could have said, Ozan, as of this morning, one of my partners in success, Saravelos, his piece is already viral. He's claiming, tongue-in-cheek, that Nvidia is almost keeping US away from a recession. All that chip story, all that capex spending, if it wasn't for that, maybe we could either question or be in a recession.
I'm not sure he's saying it that tongue-in-cheek, though.
Agreed. And also others are joining him. Again, I'm hearing from my dear friends, clients this very morning. Bain claims unless revenues quickly catch up with all this AI capex spend, we may be in big trouble. All of this will burst by 2030 and we'll go into recession before that. Now, we can say a lot can happen before 2030, but warning signs are there. Last night's big headlines, the reason why, again, Nasdaq closed on the highs. Nvidia investing into OpenAI, that also becomes almost circular. I mean, this is not tongue-in-cheek either, Tracy. Oracle invests in OpenAI, OpenAI invests in Nvidia, back and forth, back and forth. Is this a closed circle? I hear all the skepticism, also mainly coming from those who haven't caught this big rally since
a bubble is a bull market that
you missed out on.
I call gold a bubble. Tracy calls it a boom because of the difference and who inherited a bunch of gold coins.
I should just mention we're recording this on September 23rd.
Yeah, I like that. Right before Powell's speech, right before Trump's speech.
So just on AI and the sort of self-dealing circuitous, incestuous relationships, perhaps. One of the reasons we like talking to you is because you talk to a lot of clients. And so you hear a lot of feedback from the buy side as well. What are people looking out for in terms of saying, okay, this is a bubble? Because it seems like, all right, people have been talking about high valuations for a really long time. The stock just goes up. Is there something else that people are like watching for, in which case they might say, actually, we're going to start cutting back positions?
Excellent question. Almost like 2 months ago, I was hearing more, I'm skeptical, but Fed cuts are also coming. You can't fight this. Now, especially from the pros who've been around, 90s and beyond, I do hear, look, this does feel a bit like end of 90s, beginning of 2000s. By the way, the year you pick is very important there. But we may still run. That's one thing that more seasoned equity beyond macro pros are saying. It was a bit the beginning of my career, but I was around in late 90s, early 2000s. Then the denominator almost didn't exist in these valuation discussions. There was hardly any cash around. Everybody stuck. Joe.com is excellent in B2B, even better in B2C. And, of course, hindsight is the world's top hedge fund, but you could feel it. Whereas this time around, you can question the 100 billion thrown around in a circle, but you cannot question much the revenue, the cash, Jensen, Nvidia, OpenAI is bringing to the table. You cannot question much. Let's go beyond Nvidia a bit, into Magnificent Seven. Microsoft, Apple, Alphabet, they have customers. All of us are their customers. They make money. So, and in a way, talking about circle, more positive way more glass half full way of looking at it, Nvidia is the big champ. Okay, but take Nvidia aside, all of a sudden, Oracle became a story for a reason. From Oracle, we go to Alphabet because for this time around, Judge decided favorably on Chrome. The story continues, moves from one asset to another. Also, Nvidia is doing great. We'll talk about how Nasdaq, the Hercules, is catching up with my blue hat Mega. But it's rally spreading. Like Nvidia is not the top stock in S&P year to date. Talking about waiting for Godot, finally small caps rose up since the famous now another famous Jackson Hole Dowish speech. So it's not just one guy is very important. November 19 Nvidia earnings are very important, but it's not just one stock.
By the way, Ozan was regaling us or showing off his Make Europe Great Again hat. It's signed by Mario Draghi. If I owned that,
I'm very jealous.
I would not be carrying it around. I would be carrying it in a glass case and selling it maybe for eBay.
Oh, you'd have it in the vault along with your gold coins.
I would have it in the vault along with my gold. But I
that's how much I respect my clients. I want to show off.
Before we go further, actually, for listeners who maybe didn't hear our previous episode with you in April, can you just give us a little back? You talk to everyone. You have these dinners. it affords you an incredible perspective on what a range of people on the street are thinking about, just so that people can understand your perspective and where you're coming from. What do you do, like, on a day-to-day basis? Who are the range of people that you talk to, and how do you interact with them?
My job is to talk to my bank's top institutional clients.
Hedge funds, your job.
Hedge funds, real money, but also because of experience, talent, relationships going deep. This also includes now sovereign wealth funds, key private banking institutions, and as you know, I'm a person who tries to bring things together. So in these roundtables, small or big, it's not just hedge funds, it's not just real money, it's not just sovereign wealth funds. All asset classes, credit rates, FX, emerging markets, my proud terroir, equity, of course. So they learn from each other as well, because we talked about it in these shows. An equity perspective can be very different to a rates perspective. Right as we speak, again, we are in one of these doldrums on, if you define macro just as rates and FX, it's almost like a magnet. 412, okay, we on US 10-year, we tried below 4%, 412, 413, 414. As Tracy said, we are recording this on September 23. At 9 a.m. In 3 hours, Chair Powell will speak. Let's see if he changes tone or sticks to his so-called hawkish presser. Some people hope that may again ignite a little bit of dollar stronger, rates higher tone. Otherwise, volatility in FX and rates are struggling. Meanwhile, equities continue to better and better. And back to your question, different sets of clients coming to my roundtables, coming to my realm, learn from each other on why different asset classes act differently.
So you mentioned the dollar just then, and of course you have a very international group of clients that you're talking to. Can we talk about the dollar drop this year? Because I think it's really important.
Yeah.
And even though it gets some attention, it's nowhere near enough, because we're talking about stocks rallying, US stocks rallying. Things look a lot different when you start to adjust for currencies. How are people thinking about US assets in light of the dollar drop?
Very fair. I'm Team Odlos, so I also remember last time we met is April 16 in London. So just a week before the big fear. Euro-dollar was right around 110, 111. We were beginning to sense that this could be a historic year in terms of this de-dollarization, hedge fund ratios changing. But we swiftly moved beyond 115 as well. Now, looking at the picture, two things are very important. First of all, the flows. Back to our friend Nvidia, back to our friend Magnificent Seven. Because one pushback from some of my especially fast money friends who all either smell, want, or wish a dollar squeeze after such a soft dollar move is, what will the flows do? World continues to buy Nvidias and Microsofts. Do they buy it hedged? So I was a little bit skeptical on that. By the way, flows are back. So a big difference to April 16. Yeah, we can talk about that as well. Retail-led rally, look where we are, all-time highs. My research reports and claims, again, George Servalos, that in the last recent 30, 45 days or so, those flows, almost 80% of them are hedged. So people are buying their Nvidia hedged. So believe it or not, 80% is a big number. Say it's 70, say it's 60. That definitely helps the soft dollar side of things. What continues to help is, of course, institutions decreasing their exposure to US. Like hindsight, I said rightly on that April 16, nothing to end the US private side exceptionalism. Nvidia's, Microsoft's so far are fighting back the threats of DeepSeek, even though champion of the year is China Tech in terms of performance. But from Asia to Nordics, big funds are reducing their dollar exposure a little bit. 70 to 65, 60 to 55. That makes a difference. That made a difference.
This is really important. I think we should just continue on this specific line, because what it sounds like is all around the world, you have to have dollars to buy Nvidia. Nvidia is a stock that's sold in dollars. Its profits are denominated in dollars. It sells things in dollars. And that's the same for all of the Mag 7, including Microsoft and Apple. And all of them are doing phenomenally well. They have real profits, real earnings, and so forth. They're very excellent businesses. And it sounds like basically all around the world, people want exposure to a handful of extraordinary U.S. companies.
Correct.
They just don't want to take the risk that denominator, and this time we're not talking about earnings, but that the dollar that they trade in or sell in, et cetera, is going to go down further. So they want everything about this. They just basically don't want the U.S. sovereign exposure that's connected to these American domiciled companies.
Completely correct. And honestly, I was a little bit skeptic. I wasn't sure. If you told me, Ozan, this year, this big surge back in Nvidia, Microsoft won't happen, then I would feel even more comfortable with the short dollar position. But Magnificent Seven roared.
Yeah.
It may even pass mega. Despite that, dollar is also remaining soft. So whether I was skeptical or not, what you explained is happening. But I think for the next legs, ours included, a lot of buy and sell side are calling for 120, 122 like levels. You need now the European side of the story, or whoever you want to talk about, Japan, China, the lagger side of the story. FX is two-legged. We talked about why dollar side of short dollar worked.
Yeah.
We need now a bit more help from our European story.
Tracy, you know what strikes me as interesting about this, which is that when we think about countries where there's political risk and so forth, we don't often associate them with the most impressive enterprises in the world.
Right.
And it strikes me that that's the tension we're talking about here, which is that there's all this anxiety about the U.S. as a sovereign for all kinds of reasons. That's not unusual. Other countries have sovereign risk. They're just usually not home to literally the most impressive companies in the world.
No, and it is true that most of the investor nervousness around the U.S. has shown up on the sovereign side.
Yeah, not the corporate side.
Rather than the corporate side, which we've been writing about in the Odd Lots newsletter,
which
by
everyone
the way.
should subscribe to at Bloomberg.
Yes,
Go on.
Seamless plug just then. Okay, one of the other, I guess, big questions about the market right now is there's clearly nervousness about fiscal dominance and Federal Reserve independence, and that is playing into the drop in the dollar too. And yet, at the same time, stocks seem to be taking off, and a lot of investors don't seem to be that nervous, at least on the equities side. What accounts for the discrepancy there?
The two different roles. Talking about plugins, I also love the New York Times piece. I think you guys deserve all the... Trust me, all those French clients, they listen. They get very excited when I'm on. Now, Tracy definitely hit the right point. De-dollarization is one key big theme. Going into the end of the year, fiscal dominance or not, and the famous Fed independence. Those are my second and third key topics. By the way, where are tariffs all the way down to 4?
I forgot about those tariffs.
Fiscal dominance. So we talk, right? I love brainstorming with you guys. You remember what I said in August as well. Summer, everybody, like some key investors, especially fast money, were gunning for, from my dear island, 4 key trust moments in 4 countries at the same time. What does that mean? I mean, trust moments, we sadly know what I'm talking about. Long ends getting out of control for people's, for markets' big fiscal
US, UK, Japan, what's the 4th?
For the right reasons, Europe booms.
Okay.
For the right reasons, because ramp up, the German spending will come at the end of the year, etc. Some key investors were asking, well, one trust moment, we know how we handled. Chancellor, then Prime Minister goes, different sets of policies. What happens if 4 goes at the same time? And we tried this on, talking about dates. September 2, when you guys came back from, wherever you came back from on the final long vacation, long weekend. UK gilts, big move, followed by France, because the Prime Minister was about to go in 6 days. Joe and Tracy, how long did it last? 4 hours. That long end sell-off lasted 4 hours. And I'm not trying to be funny. Basically, since then, US 30 years, Europe, even UK has been much more under control up until the hawkish pressure, almost threatening below 4%, even more than short dollars, Tracy. Over the summer and into fall, what were the real money and hedge funds' common favorite trade? Steepeners. Europe, US, everybody and their brother had steepeners. First, for different reasons. On US, more due to the short end. That sooner or later will come to the Fed independence. The Trump side of the equation would win more. Finally, Powell would cave in, cuts would come in. And on the European side, even more popular because of the long end. German spending coming through in October, November. People believed in their steepeners. First, US got hurt. 2 NFPs miss. Long end moved big. Flatteners hurt. gold aside, whenever you say, or Nvidia aside, whenever you say somebody says a trade is untouchable, watch out. European steepeners were supposed to be untouchable. 2 days after that flattening washout in US, Europe also got reduced. And since the hawkish pressure, we are more balanced. On to Fed independence. Again, just this morning, off the press, Matt Raskin, my head of US rate strategy, previously from the Fed, very respectable analyst, wrote about this Fed independence fear not being in the price, not in the break-evens, not in the term premia. Why? I think a little bit because so far, let's dive right into it if you wish, I think this cut is justified. In my mind, even if they cut 50 a week ago, it could have been justified. Talking about some dear clients, friends, public, so I may say, Rick Reader, publicly on TV and on his writings said, they may and they should cut 50. Because I think if they saw the revisions in June and July, they probably would have cut in June and July. And going forward, okay, they cut 25. Not only they cut 25, Miran did his thing, probably, that's the dot. But Waller, Bowman stuck to 25. Even some of the previous Fed governors racing for the job, Bullard says they should have done 25. So people are thinking and hoping that there is still some Fed independence. Powell, even though he's the past man, has some control over the situation. That's why we're not getting any Fed independence fear on the long end.
Joe, it is interesting, and I would not have expected this earlier in the year, but if you look at the MOVE index, so the index of bond market volatility, it's going down. It's gone down quite a bit, which is not exactly what you might expect to happen when we're talking about things like fiscal dominance and Federal Reserve independence. But there you go.
That is a good chart I haven't looked at in a long time. I want to go back to the gold conversation because we kind of been dancing around it. We're like, oh, political volatility in the U.S. and sovereign risk in the U.S., et cetera. But like, let's talk about like gold in the U.S. or gold in the dollar. Like, when you talk to clients, setting aside that it's a good trade, people want to ride a good trade, et cetera, how much fear, anxiety, et cetera, is there about U.S. political stability? And what are the, a prominent political commentator got assassinated recently in the United States.
Sadly.
What are people at your dinners, maybe inside the U.S. or outside dinners, saying about the U.S. when they look at our country?
That's why more and more countries are building up their reserves in gold, shying away from dollar more. My motherland, Turkey, is an example, again, publicly known in terms of reserves. Also, let's remember what is still going on versus Ukraine and Russia, the sanctions that Russia faced or may face. So different countries are also, because of that, leaning more towards gold. So besides our macro discussions, ups and downs of rates, that uncertainty, that question mark over US policy, that question mark over geopolitics lead central banks to accumulate more gold. Joe, for gold to go down, the game should change. Like this year, my game plan is going all right. Again, I was on air. I thought these big steepener trust moments, long ends, crushing everything wouldn't happen. I didn't expect this much of a comeback. But again, I said there would be a comeback, especially retail, much more than pros believed in this. Nvidia, gold go hand in hand together. There should be something off the left field. For example, maybe on tariffs, all of a sudden, tariffs, tongue-in-cheek, Tracy, are a bit the good boy. Revenues, they raise a lot of revenues. Twitter talks about it, TVs talk about it, Torsten Stock talks about it. If Supreme Court, at whatever time, and that's also very key when they make the decision, votes against, I'm sure they may, I know they may use S301, etc., but will be all of a sudden a big, that's the question mark now. What will the Trump administration do? What will Besant do? Long ends can get going again. And even though it's got nothing to do with necessarily Nvidia and gold, the year's path may change. And things like that can take us off the...
What about a big handshake with Xi Jinping and a new... I don't know what it would be. And, my dream, obviously, is for a BYD factory in Tennessee one day, a Xiaomi factory, et cetera. But could that be this charts us in a new direction, something that is like a real... Let's reset this relationship. I'm not optimistic, but would that be the type of thing that could reset the trajectory of certain markets?
You talk like my Joe. I like it. Globalist, Tennessee factory, BYD. That's not the Unga Pulse at the moment. Sure, if that happens, my gut feel still says short-lived correction. But yes, that what did I say? That's not the UNGA pulse. That's not the New York pulse at the moment. It would be a positive surprise, a little bit less scared of things surprise. And I could see that hitting gold.
So I know it's number 4 on your list now, but we should talk about tariffs a little more.
We should.
And I take the point that it could be a revenue generator for the US, and maybe that provides some support on the bond side of things. But on the other hand, I think most people would argue that it would slow economic growth, which should be a drag on the equity side, but we haven't really seen that. How are people talking about the actual impact of tariffs right now? And I got to say, Joe, I got my first customs bill over the weekend. It wasn't too bad. I think it was like $16 or something. But they're here.
There you go.
I feel them personally.
Very fair comeback, I guess. Especially fast money crowd hasn't necessarily given up on stagflation. My take, for part of the reason why all these Nvidia, gold, long and calls have been correct, I like to fade the inflation hawks and I like to fade the big recession bears who are much more quiet these days anyway. But yes, if President Trump continues to stick to them, even though on one hand they generate revenue and keep the long end under control, there may be a growth impact on the other side, accompanied by supply side immigration effects. And the jury is out there on Dear Mr. Waller, whether led by him, whether this is the famous word, T word, whether this is transitory or not. More and more, some clients start to say, my Binky, the famous chief global economist, start to say maybe this tariff effect wasn't as bad both on growth side and on inflation side. These people immediately get a pushback. Early days, let's wait. So will companies continue to eat them and not pass that much to the Tracy's of the world, to the customer, especially when we talk of beyond 10% tariffs, which most countries face? Next year, your country faces a very key midterm elections. So I think Trump and Besant know that they got elected because of inflation. So the moment the stagflation camp starts to look like they are proving correct, even look like a bit of a climb on inflation, more slowdown on growth, I think we may get more and more taco because they want to win those midterm elections. Then they would take more and more steps lower on tariffs. But if they prove correct, if it's not reflected on the customer, if inflation continues to remain, okay, I know it's not 2%, but below 3%, maybe this status quo continues.
Sorry, did you just call Binky Chada my Binky?
Yes, I did.
Love it.
Even like when there's a lot of preparation going for these macro dinners as well. Trust me, when he sends his questions and his key bullet points, he tells me to start with my Binky. So you're right.
I don't think we've ever had him on the podcast.
No, we should.
We got to.
Yeah, you should.
Yeah, I talked to him a couple of times on TV. Big fan of his. We got to make that happen. When you think about the U.S. economy and maybe the European economy too, but I think it's the U.S. And you think about growth prospects. This is something I've been asking a lot of people about. Like, how much do you think the U.S. economy, as just the forward momentum of the U.S. economy, especially over the course of your career, how much has it become dependent on this perpetual rise in asset values? Mm-hmm. And you think, like, do we need a booming market year after year just to keep that sort of like consumption demand engine, investment engine going?
Well, yes is the short answer. I think the details are even more complicated and a bit sad. I think we need in this game that thing, IT, the next thing. It was B2B, B2C 3 decades ago, 3D, now, of course, AI, past 3 years. And also US, I mean, again, as I said, the country that gave my education, right, in more open times for that, relies on growth, relies on animal spirits, relies on those asset classes to go higher and higher. And that's why the Tracy question from like 10 minutes ago is very key. Whether we are at, we're getting their stage of the bubble or we're at the bubble, because if that bursts, economy can get affected as well. Also, Joe, I'm a big believer in the K economy, the whole terminology of that. So I said this again before on your shows. world may be more okay for whatever we define ourselves as 1%, 5%, 0.1%. There's a much bigger part who are struggling, definitely on US, but globally as well. Some, again, it's a statistics thrown out there. These days, 10% of the US consumers accumulate almost 50% of the consumption. And the rest, much less. Wealth effect is getting bigger and bigger. When I was in college running around in this country, again, we were talking about the wealth gap. But now this becomes relevant, even macro relevant. That's why people like me are okay with the rate cuts, risk management or not.
When you encounter Americans in London or Americans in Europe or anywhere outside
Englishmen in New York,
do they badmouth U.S. policy? Do they talk about how terrible and how much our institutions are deteriorating and how we need to get back to that sort of good old-fashioned IMF orthodox economics of the good old days?
Okay, let me get the pass from Kobe and do a bit of a shack. Look, they do. It's some of, especially if they have, like me, born and bred emerging markets, but now trading the whole wide world. And if they are Americans touring my beautiful world, they are affected. When they hear conversations like this, they understand. When they traded Turkey, Hungary, Argentina, and say, okay, because of this politics, financial repression, I don't believe it. That's why I'm selling the currency. It was easier to do for somebody else's land and currency. Now, both it hurts them a bit, and also it becomes a bit of a dilemma, right? They may continue to criticize some of the things that are going on, but for the arguments that I laid out, risk parity, at least the equity part, continues to do okay. And US 10-year still is not going to 6%. It frustrates them. This brings me to, not in our big ones, but big thematics, a key point. Going forward, much beyond the fourth quarter, what's going to win? The trust moments, my symbolic way of saying fiscal dominance, or financial repression. Again, as somebody who's experienced in these Turkeys, Hungaries, Argentinas of the world, what does dear Mr. Besen say as a former client friend, still a friend? Bending the curve. He literally said, I'll bend the curve. We will take care of the curve. He said bend, even not take care of. Maybe through, like they do, being very watchful over the auctions, making sure auctions go very well, which they have been, one TIPS auction aside. Maybe through buying much more on the short end, vice versa, buying more on the long end to make sure that those rates stay under control. Operation Twist, a la 11-12. They may win over majorities thought that fiscal dominance will win. My gut feel continues to say, don't necessarily bet against, whether you like it or not, Fed and Treasury working more closely together on this a la US financial repression. Going back to your question, some clients, Americans I meet in New York, London, or Sao Paulo, are a bit taken aback by saying, are we becoming a bit emerging marketized? What do you mean by Treasury and Fed working even closely together? This is not 2008, 2009. But so far, those who bet towards that, those who bet with Mr. Besant, did better on their long and US views.
Speaking of the wide world, what are your clients saying about China in particular? Because, I'm looking at a very good Bloomberg story on my screen right now. China floods the world with cheap exports after Trump's tariffs. And I think they just posted a record trade surplus.
And there was another good article this morning, China wanting to be a gold storage hub, which I thought was really striking.
He really did become a gold hub.
Doing a Switzerland, I guess. And the free ports. But on the other hand, growth has been slowing in China and there is deflation. But if you look at something like the Shanghai Composite, it feels like people are starting to get a little bit more optimistic. What are you hearing?
Three parts to that. First of all, China as an asset class. We have it here as, alongside gold and emerging markets, champion of the year. In December, November, January, earlier, everybody and their brother, like the steepener trade of this August, early September. It was the top trade, going long dollar CNH. These tariffs, lightizer, they would be the toughest on China. There is no way. All the dollar CNH calls were bought, starting with 7.5, strikes at 8. All of that didn't materialize. Okay, we didn't go to 690, 680, but the CNH is appreciating. Talking about the day we made April 16, on April 9, the big fear was on that morning when we questioned the system, April 9 morning, China would devalue big time, big bang. They didn't do any of that. And currently, my head of Greater China Trading, Tan, who, name drop, nicely called this China Tech and CNH rally, thinks that, and with his research, RMB strength has more legs to go. Because wherever they go around the world, Peru ports, Brazil, Amazon forests, following the China corporates, back to our discussion, these guys are full of dollars out of their ears. And now for discussions, for the points that you mentioned, they want to hedge a little bit. So they want to sell their dollars a little bit. And that's a big factor. So that's, I think, China Tech will continue to be the champion asset class. Gun to my head, maybe not going to 690, 680, but I am still betting with CNH and RMB strength over dollar strength. One of these laggers of the year will do better. To the world effect, you guys actually, Bloomberg had a great piece this very morning, like Tracy said, on exporting disinflation. So two big countries in this world are America and are China. Mr. Trump is doing what he's doing on the tariff side. These other big countries of the world don't necessarily fight with the other big giant in the world stage. So those cheap cars are coming into Europe and beyond. And that is a macro factor. Why? Because ECB, back to blue hat now, they're done. Madame Lagarde very defiantly says they're done for now. Madame Schnabel for now is winning the discussion. Even Lane is sounding a bit more like her, more hawkish. Let's see. We don't have an inflation problem. Printing below 2%. If anything, my Mark Wall, chief European economist, thinks it may go lower to 1.6, 1.5. If that happens, let's see what their tone is come December, come January. If this China continues to export to disinflation, maybe even though they don't say it now, they may have to end up cutting. So that's a big factor for the European story.
Joe, we should have asked Ozan to wear his Europe hat for this entire interview.
I know. It's a cool hat. Ozan Tarman, Vice Chair of Global Macro at Deutsche Bank. Always a pleasure meeting up with you. Always seems to be at exciting times in the market. Also, we like talking to you because it's just a list of Deutsche Bank analysts is like, oh yeah, we need to talk to that guy. We need to talk to that guy.
That's part of my job. Bring them on.
Yeah, right. I know. Good sales. Anyway, thank you so much.
This was great. Thank you so much.
I love catching up with Ozan for all kinds. Always really fun. He has a great read on what are the popular trades.
Oh, for sure.
Right now.
Or just the talking points, right?
And the talking points. This idea that, we don't talk about the Chinese market that much in terms of the stock market. We do a little bit. But the idea that from his perspective, long China is up there right now with all the big ones, Nvidia and gold, and up until recently, the steepener, maybe that's fallen off a little bit because it hasn't worked as well, that this is one of the sort of top tier consensus trades right now, something that we should probably talk about further.
I also find it interesting that tariffs have fallen from number 1 on the list of concerns to number 4, if that.
No, that's totally right. I mean, when we talked to him, that was middle of April in London, or early April, I think. And so it was all about tariffs. And yet, despite the fact that tariffs are not top of mind for a lot of traders apparently right now, it is interesting that still this idea we don't really want to have exposure to the U.S. per se. We want to have exposure to U.S. companies, but not the U.S. per se. That's all part of the story.
Speaking of which, another really good chart to look at right now is gold versus real rates. So you can bring up tip yields or something like that. And you can see there used to be a really strong, almost 1-for-1 correlation, and that's broken now.
That's very interesting, right? Because it suggests that there's something else going on, right? Because it's very easy to say, okay, real rates, et cetera, they're going down. You want to
I think it's that sovereign concern.
It's that sovereign concern. It's like something deeper, and it may be deeper to a lot of different sort of, Western governments and fiat currencies and so forth. A lack of trust, maybe something that doesn't show up in a traditional market, showing up in gold. I do think that's really important.
Yeah. All right. Shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Wasenthal. You can follow me at The Stalwart. Follow our producers, Carmen Rodriguez at Carmen Armand, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. For more Odd Lots content, go to Bloomberg.com/oddlots. We have a daily newsletter and all of our episodes. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you like it when we get a read on what people are talking about in markets, then please give us a positive review on your favorite podcast platform. And remember, if you are a Bloomberg subscriber, you can listen to all of our episodes absolutely ad-free. All you need to do is find the Bloomberg channel on Apple Podcasts and follow the instructions there. Thanks for listening.